Let's talk about the conceptual framework behind financial reporting because the individuals that create the accounting principles, they do not work in a vacuum, but they follow a set of concepts. And the concepts are broken down into four categories: qualitative characteristics, assumptions, principles, and thresholds and constraints. So, in terms of qualitative characteristics, I'm sorry, let's talk about the qualitative characteristics first. It should be relevant. It is relevant if the information has potential to make a difference in the decision of users. Relevant data helps predict organizations' future performance or confirm their price or current understanding of organizational performance. And there should be faithful representation, which means there is comparability. So similar items are measured and they are reported in a similar way, so there is consistency there. Verifiability, which means that uh, observers would concede that data faithfully represents economic activity, and it is important that it is true, right? There is truth in there. Timeliness, decision makers have data in time to influence their decisions, and they should get it in a timely manner. And understandability, which means data is classified and characterized and presented in a way that users can understand information that is being conveyed to them. So the next conceptual framework is based on assumptions. When it comes to assumptions, you define the accounting entity, which can be a system or an individual organization. So, what entity are you referring to? Is it a hospital? Is it a healthcare organization, which is probably a long-term care? Is it a nursing home? Is it a rehab center? Is it a physical therapy clinic? So we need to specify the entity for which the statements apply can be defined. And a healthcare system may create one set of financial statement for the system as a whole and separate sets for subsidiary hospitals or affiliated hospitals. Then the next one is going concern. It is assumed that the entity will have an indefinite lifetime rather than be liquidated in the future. We are already assuming that the entity is going to keep going. Um, so the assets should be valued on basis of their contribution to an ongoing business. Land value to hospital is, let's say, $50 million, and land value to outsiders is $20 million. So that is a going concern. That the value of the land to the hospital is quite more than the value of the land to the outsiders. Maybe the hospital is in a rural area, right? And nobody wants to go and build a house there. Nobody wants to go live there. But the value to the hospital is $50 million because they are getting patients. They are getting making revenues just by being a rural hospital. They are getting some subsidies. They are getting, they are a Medicare hospital, and all of that is helping them generate revenues. The next one is periodicity. The fiscal year is the one which is important here, and the time period which is applicable to the statements. And when that can be defined, that is known as periodicity. Fiscal year may not coincide with calendar year. It runs from August 1st to July end. For example, for UNLV, it runs from August 1st to July end. The next one is monetary unit. The monetary unit of measurement can be defined. If it is, for example, a United States hospital, then it should be US dollar, which is unadjusted for inflation or deflation. Then there are some principles. For example, historical cost requires most assets to be valued at acquisition, historical cost rather than fair market or current value. Revenue recognition. Oh, I'm sorry, just going back to historical cost one more time. It requires organizations to report the value of assets based on acquisition cost rather than current value. So let's say the value of the land 20 years ago was $1 million and the current value is $2 million, but it is still reported as $1 million, and that is the historical cost. We are not reporting the fair market value, but we are reporting the value that it was acquired at. Revenue recognition. Revenues must be recognized in the period in which they were realized and earned. So let's say you did a patient service, you did a procedure or surgery in the year of 2022. So, um, and you get the payment for it in January of 2023, then you still have to go back and put the money received in 2022. You cannot account for it in January 2023 because the service was rendered in 2022. Okay? Expense matching. Expenses must be matched in time to the related revenues. Expenses are matched to the revenues to which they relate. Example, you spread over the cost of MRI machine over several years because if you paid $50,000 for that MRI machine and you have been using it for the next 10 years, you will think that you have paid, let's say, like $500, $5,000 every year for the next 10 years for that MRI machine. And that is expense matching. You spread the cost of MRI machine over the next 10 years. Full disclosure is giving a complete picture of economic events. Financial statements must contain a complete picture of the economic and financial events of the organization. Accounting methods can be of two types: cash accounting and accrual accounting. Cash accounting recognizes an event when a cash transaction takes place. It is simple and easy. It also mimics the tax statements. Whereas accrual accounting recognizes an event when a cash obligation is created. It is more complicated. It provides a better picture of the true economic status of a business, and it is required by the GAAP. Modified cash accounting is a blend of the two methods often used by small, non-GAAP businesses. So cash accounting basically is saying that economic events are recognized when cash transaction actually occurs. It is most important to record it is the receipt of cash, not the provision of service. Um, it can be single and it can be aligned with tax purposes. 80% of medical practices use cash accounting. Whereas accrual accounting says that the economic event that creates the financial transaction provides basis for accounting entry, not the receipt of cash. So when you perform the surgery or when you provide the service, you create the economic event. You create the financial transaction. You have already, you've already done a business, even if you have not received the money, even if you have not received the cash. But cash accounting says that the transaction occurs only when you receive cash. It has not occurred until you have received. But if you have not received, the transaction doesn't even take place until you have received cash. And that is why it is simple, because when you have the money, that is when you have the money, right? And that is also aligned with tax purposes. But with accrual accounting, payment comes from the insurer and not received until later, right? And the dollar amount is not received, it is listed as accounts receivable. So the money is yet to come in accrual accounting, but in cash accounting, the money is right there. So the next one is income statement definition. It is the most important question about a business's financial status, that whether the business is making money or not. That is the most important. So the income statement provides information about a business's operations and economic profitability. The income statement is often called by other names like statement of operations, statement of activities, or statement of revenues and expenses. It summarizes activities of an organization with a focus on revenues, expenses, and profitability. Revenues are cash received and unpaid obligations. Expenses are operating expenses minus salaries, supplies, and insurance. So the income statement reports the results of operations over some period of time. For example, let's say a year. It has three key elements. Revenues under accrual accounting, they represent both cash received and payer obligations. So if you have patients who are supposed to pay you still, that is a part of the revenue. But what is also included is the cash that you have already received. Expenses says that the resource expenditures that are required to produce the revenues. Note that under accrual accounting, both cash and non-cash expenses are recognized. So if you have paid a vendor, then that is a part of the expense. If you have yet to pay a vendor, if you have yet to pay some agencies or vendors or suppliers, that is a part of your expenses too. And profit is profit, which is operating income when you minus the expenses from the revenue. and it is also called the net profit or the net income. So we'll look at Sunnyvale Clinic, for example, revenues in thousands. The operating revenues include net patient service revenue, which is approximately $150,000 for 2020 and $120,000 for 2019. The premium revenue, which comes from some other sources, is $17,000 for 2020 and $16,000 for 2019. And there is other revenue which comes from still other sources. For example, let's say a parking lot or gift shop, and that is $3,000 for 2020 and $2,700 for 2019. So you get the addition of all of this, all the different kinds of revenues, to get your net operating revenues. Now, um, patient service revenue is saying that the revenue that you strictly get from patient services. Premium revenue is coming from capitated patients as opposed to fee for service. There is certain per member per month patients that are given a fixed payment, fixed reimbursement from the insurance company, and that is the premium revenue. Other revenue is mostly parking lot and gift shops and other different kinds of things, and that is a total of all of that is net operating revenue. So the revenues are shown in several different formats depending on the type of provider. Sunnyvale reports several categories of operating revenue. Like we saw earlier, there was um, net patient services revenue, premium revenue, and other revenue. So we talk about the net patient services revenue again. It represents the amount based on payer contracts as opposed to charge master prices, right? We talked about charge master prices in the last chapter, and you have a charge master where you have different services, and they have a list, and all of the services have a price associated with them. That is the charge master, and the provider is paid based on the charge master when the charge based reimbursement is in effect. Um, so the net patient service revenue base is basically saying that whatever the contract says between the payer and the provider is, that's what you get. Okay, and it includes only fee for service revenue. It does not include any capitation revenue. It accounts for price concessions. It accounts for negotiations and discounts, explicit, which are through contractual allowances, and quite explicit and implicit, for example, based on historical data, deductions, bad debt, and with which you talk and come to a possible negotiation, like after the fact. Premium revenue reports revenues from capitated patients as opposed to the fee for service. Remember, capitated patients are the per member per month patients. You have a fixed number of patients that the payer will say that we will give you only this amount of money, and for 50 patients for each month. Other revenue represents revenue from other services like office rentals, parking fees, cafeteria sales, gift shops, and things of that nature. Net operating revenue reports the total amount of revenues that are related to patient services. Revenues and accrual accounting. Because of accrual accounting, remember, accrual accounting is uh, you have rendered the service, but you have not received cash yet. The net operating revenues reported do not represent the actual amount of cash collected in each year. We think that we will get the money, but sometimes you have to write it off as bad debt. Think of a person who's coming from outside of United States and lands up in the emergency room because they had a stroke or something. Uh, they do not have any insurance here. They do not have anybody and they went back home, right? They went back to their country, and they went to the emergency room, and the total cost was $10,000. Who is going to pay the $10,000? It must be written off as bad debt because you don't have anybody to even send to collections. You don't even have anybody's social security number. So some portion has not yet been collected. The uncollected portion will appear on the balance sheet as net patient accounts receivable. In addition, some revenues reported in the previous year were collected this year. So Sunnyvale Clinic has, this is the expense sheet. For 2020, let's say the expenses are you provide salaries and benefits for your staff and providers, medical staff, clinicians, and so forth. For 2019, it was $100,000. Supplies is $20,000 for 2020 and approximately $18,000 for 2019. Insurance is $4,500 for 2020 and $3,700 for 2019. Lease is $3,100 for 2020 and $2,600 for 2019, and so on. You also have depreciation and interest in there. So the total expenses is approximately $166,000 for 2020 and $136,000 for 2019 for Sunnyvale Clinic. So there is some classification of expenses. Expenses represent the resources that are used to create revenues. They are the cost of doing business. Like revenues, under accrual accounting, expenses do not reflect cash outlays, right? They do not reflect any cash outlays. Expenses can be categorized as natural classifications such as salaries, supplies, research, and so forth, and functional classifications such as inpatient services, outpatient services, and so on. So there's a few categories for expenses. Salaries and benefits. That salaries and benefits expense represent labor cost. Typically, this is the largest expense category for health services organizations. Although only summary information is given on the income statement, details are available internally from the managerial accounting system. Supplies expense represent the cost of expendable materials. The dollar amount shown represents the amount consumed, not the amount purchased. Supply stocks are reported on the balance sheet as inventory. The next category is insurance and purchased services. Um, Purchase services are more like third-party lab like Quest Diagnostics, and insurance expenses is protection against bad weather, fire, and so on. Um, Depreciation is wear and tear on property and equipment. Insurance expense represents the cost of commercial insurance that you want to insure your building against risk, against fire. So there is property risk, there is liability risk. If somebody comes and falls in your hospital, let's say they don't have any other issue, they came with their spouse to get them treated, but they fell. So that is a liability, and that you need to insure yourself against that liability. Purchase service reports the cost of reference lab services provided by a third party, like I told you earlier. And depreciation expense arises because of the expense matching principle. Expense must be matched to the revenues with which they are associated. While operating costs such as labor and supplies are assumed to produce current revenues and hence are immediately reported on the income statement, the cost of long lived assets such as building and equipment are not reported on income statement at the time the acquisition is made, because labor and supplies are assumed to produce current revenues, right? As soon as you hire a nurse, she starts seeing or he starts seeing a patient right away. Uh, and uh, if you acquire a building or an MRI equipment, it probably is just sitting there for a month and getting painted, getting cleaned up, and you have not used it for any patient yet. So it might be discharged, it might be broken, it needs another touch up and so forth, and you need to do all of that before they can start utilizing it for patients. So the cost of long lived assets are not reported on the income statement at the time it is acquired. Expenses are also non-cash and interest. Most expense items listed on the income statement only approximate actual cash expenditures. The relationship is not exact because of accrual accounting. However, depreciation has no associated cash expenditure. Such an expense is referred to as non-cash expenditure. Interest expenses reports the amount of interest that is paid or obligated on debt financing. So the cost of access, example, land when acquired, are not reported. And I told you earlier that the expense matching principle, through that, the cost should be matched to accounting periods during which assets produce revenues. The depreciation expense is usually it spreads the cost of fixed assets. Um, an annual depreciation expense is calculated as a difference of initial cost and salvage value divided by the useful life. For example, let's say your initial cost of $150,000 of that MRI machine, and it is broken now, and now the salvage value is only $25,000. So you'll subtract $25,000 from $150,000 and divide it by the number of useful years, which is, let's say, 10 years.